Welcome to Latiques. Join us as we take you through the topic, Education and Fundamental Knowledge in Forex Trading. Before trading, you must understand the basics of the market like terminology, understand currency pairs, base versus quote, pips, lots, leverage, and margin. Market methodology, fundamental. That means understanding market drivers and how they influence the market by learning interest rates, inflation, economic data, GDP, employment, and geopolitical events. Technical. That means understanding how market patterns are formed and what their interpretations are by developing skills in technical analysis, that is studying charts, trends, indicators, and candlestick bars. It is quite important you understand Forex trading terminologies so you could relate with the market. These terminologies are terms used to describe currency trading mechanics, risks, and market movements. Let us look at the most important terms. 1. Currency pair. The base currency against the quote currency, for example, EUR/USD, indicating how much of the quote currency is needed to buy 1 unit of the base currency. A currency pair is the quotation of two different currencies traded against each other in the Forex market, determining the value of one currency relative to the other. It consists of a base currency, which usually the first currency, and the quote currency, which is second currency. While the first, base currency, is usually fixed at 1 in value, the second, quote, is in the value of the currency at that moment in the market, and this indicates how much of the quote currency is required to purchase 1 unit of the base currency. Example, EUR versus dollar is depicted as EUR/USD. In this case, the EUR is base, and the USD is quote, hence the value of the EUR is 1, and the USD is 1.15937, which the price for that moment circled in red. 2. Bid/ask, pips and spread. In Forex trading, when dealing for instance in the EU/USD pair as depicted on the page, the term bid is the highest price a buyer is willing to pay, and the ask is the lowest price a seller will accept. But in action, you sell at the bid and buy at the ask. The difference between them is the spread, which represents the transaction cost. Example, if the EUR/USD quote is 1.15869/1.15870, this means you can sell EUR at 1.15869, and you can buy euros at 1.15870. 3. The spread is 1.15870 minus 1.15869 equals 0.00001. And the fourth decimal place is 0. This is equivalent to 0 pips, which is the smallest price movement. 4. Leverage is technique designed to help trader borrow funds from a broker to trade larger positions with a smaller deposit. It does magnify both profits and potential losses. This loan is usually in ratio of the amount of capital you deposit to the broker. Common ratios ranges from 1 to 10 up to 1 to 1,000 or higher. Example, for a 1 to 100 leverage, if you deposit $100, then you will be allowed to have a buying power of 100 multiplied by $100, which is equal to $100,000 in the market. You exercise this buying power in your position size. Position size enables traders to open larger positions, for example, higher lots, than their account balance would otherwise allow. And not that as a result of leverage, you will be involved in some cost because of overnight financing for positions held open to the next day. 5. Margin. Margin in Forex trading is the minimum deposit required by a broker to open and maintain a leveraged position, acting as collateral rather than a fee. It allows traders to control larger positions with a smaller amount of capital, essentially enabling the use of leverage to amplify both potential profits and losses. Key aspects of Forex margin. Good faith deposit. It is the portion of your account funds held by the broker to cover potential losses. Neat. Used versus free margin. Used margin is locked in active trades, while free margin is available for opening new positions. Margin level. This is the ratio of your account equity to the used margin, expressed as a percentage. A low margin level, often below 100%, can trigger a margin call, prompting the broker to close positions to prevent further losses. Example: calculation. To open a standard lot, 100,000 units of euros to US dollars, you need a 1 to 100 leverage. And not that as a result of leverage, you will be involved in some cost because of overnight financing for positions held open to the next day. 6. Lot. The unit size of a trade. A standard lot equals 100,000 units of currency. In Forex, a lot size is the standardized quantity, number of units, of a base currency bought or sold in a single transaction, determining the trade's risk and profit potential. Common sizes are standard units, mini, micro, and nano. It defines the dollar value per pip. Key lot size types in Forex. Standard lot, 1.0. Units of the base currency. Mini lot, 0.1 units. Micro lot, 0.01 units. Nano lot, 0.001 units. Usage examples and impact. Risk management. A beginner with a $1,000 account might use a 0.01 micro lot to keep risk low, while an experienced trader might use 1.0 standard for higher gains. Pip calculation. On a 1.0 lot, 1 pip in pairs like EUR/USD typically equals $10. On a 0.01 micro lot, 1 pip equals 10 cents. Margin requirement. A larger lot size requires a higher margin, collateral, from the broker. Position sizing. If you want to risk only 1% of a $10,000 account on a 50-pip stop loss, you would calculate the appropriate lot size, approximately 0.2 mini lots, to manage risk. 7. Long versus short. In Forex trading, going long means buying a currency pair expecting its value to rise such that you profit from a price increase. While going short means selling a pair expecting its value to fall, that means profiting from a price decrease. What does it mean to place a trade for long position? It means buying the base currency, first currency, and selling the quote currency. It means you interpreted the market is bullish. Other words, the price will increase. It means you buy low and sell high later. Example: buying EUR/USD at 1.15978, blue cross, and closed at 1.16231, white cross, is equivalent to 0.00253 increase. What does it mean to place a trade for short position? It means selling the base currency, first currency, and buying the quote currency. It means you interpreted the market as bearish. In other words, the price will decrease. It means you sell high and buy low. Example: selling EUR/USD at 1.16231, white cross, and closed at 1.15978, blue cross, is equivalent to 0.00253 decrease. 8. Bullish versus bearish. Bullish and bearish represent the two primary market directions in Forex trading. Bullish means expecting or observing rising prices and upward momentum. Bearish means expecting or observing falling prices. 9. Stop loss and take profit. Stop loss is an automatic order to close a trade at a loss to prevent further damage. Take profit closes it at a profit. Stop loss, SL, and take profit, TP, are automated risk management orders in Forex trading that closes a trade at predetermined price levels to limit losses or lock in gains. A stop loss acts as a safety net against unfavorable market moves, while a take profit secures profit at a target level. Examples: the picture shows buying EUR/USD at 1.17911, setting a TP at 1.18334, target profit, and stop loss at 1.17745, maximum acceptable loss. 10. Slippage. This is the reason a trade executes at a different price than requested due to high volatility. Slippage in Forex is the difference between the expected price of a trade and the actual execution price, occurring when market orders are filled at a different price than intended. It happens mostly during high volatility or low liquidity, such as during news events. It can be negative or positive, resulting in higher costs or better prices. Example: the picture shows a sell order of euros to US dollars and 1.18165, setting a TP at 1.17745, target profit, and stop loss at 1.18334. But when the trade closed at the stop loss, it was at 1.18508. So, the difference or gap between the set stop loss and the executed stop loss is called slippage. Types of slippages. Negative slippage. Execution price is worse than requested, for example, buying higher or selling lower than planned. Positive slippage. Execution price is better than requested. No slippage. The order is filled at the requested price. Impact. Slippage can increase trading costs and reduce profitability, especially for high-frequency or scalping strategies. How to minimize slippage. Use limit orders. Instead of market orders, limit orders ensure you only enter at the specified price or better, though they may not fill at all. Avoid news trading. Avoid trading during high-impact news releases when volatility is extreme. Trade high-liquidity pairs. Focus on major pairs, for example, EUR/USD. During active market hours, use good internet. A fast, stable connection reduces the delay between clicking buy/sell and the order reaching the broker. Set deviation limits. Some platforms, like MT4, allow you to set a maximum deviation or slippage tolerance in pips. Slippage is an inevitable part of trading, especially for traders who rely on market orders, but its impact can be managed with proper strategy. Now that you have acquainted yourself with the basic terminologies in Forex trading and their interpretations, we hope you will be able to relate as we proceed to their applications. Please note we are technical traders, so we are commencing with technical trading methodology. In our next lesson, we shall be taking on trading platform and understanding tool under Forex broker and account type. If you have learned anything from this video, please like, subscribe, and share. In this way, you get notified once we drop a video. Thank you!